everyone. Please let me know if you can see my screen and also hear me. Hi guys, can you hear me and see my screen? Okay, so welcome everyone to today's IC Markets Global webinar. Today's topic will be about the common mistakes that new traders make. Okay, and before we start, just a quick disclaimer. Everything that we share in this session is purely educational purpose and should not be constructed as investment advice or investment recommendation. Please do your own due diligence before you do any trading. And if you have any questions along the way, please feel free to let me know. You can enter your comment in the comment section. Okay, and this is today's agenda. So there are you'll be looking through at 7 common mistakes new traders make. So the first one is not having a trading plan. Second one, no stop loss, no risk management. I do live. Hello everyone. Are you able to hear my voice and also see my screen? Thank you everyone. Sorry for the delay because we are having some connection issue. We will start the webinar now. Thank you for your patience and waiting. Okay, let me start the webinar. Thank you. Okay, please feel free to leave me a comments if you have any questions along the way. Okay, so today's topic is about 7 common mistakes that new traders make. Okay, so before we start, this is a disclaimer. Okay, please note that everything is educational purpose. Okay, and should not be constructed as an investment advice or investment recommendation. So before you start taking any trade, please do your own due diligence. Okay, and this will be today's webinar agenda. Okay, so there are 7 common mistakes that new traders make, like not having a trading plan, no stop loss, no risk management, and also over trading and ignoring the fundamentals, and also the importance of having a trading journal. Okay, and before we start, introduction of myself. I'm Emily from EFG, Everest Fortune Group, and Everest Fortune Group is finalist for best FX research, and also finalist for best equities research. Okay, so for a start, the importance of having a trading plan. Okay, because it helps you to be consistent in your trading and also helps you to be objective in your decision making. Also very important for risk management to focus and also evaluate your past performance and also give you the confidence for your future trade. Okay, this is the anatomy of a trade. Okay. In order to manage a trade, it's important to understand what a trade consists of. So in this webinar, we'll be introducing the basics of trading, the entry, stop loss, and take profit. We will go through break-even and partial on profit strategies in the trade management and also idea invalidation, and also some trading stop loss in the final part of our trade management series. Okay, so trade management refers to process of managing open trades in the financial markets to maximize returns and minimize risk. Here are some common trade management strategy for beginners. So there are examples like stop loss order, take profit order, position sizing, trailing loss, and also diversification. Okay, so it's important to remember there is no one-size-fits-all approach to trade management, and different strategies may work better in different market conditions and for different types of trader. So later on, we will go more in depth into the different kind of stop loss, take profit order, and also the position sizing. Okay. Okay, now we will look at the first one, trade management. And why trade management is important? Because it helps to control risk. Okay, helps to control risk. It also limit potential losses and manage overall risk exposure. And trade, how do we control risk? Give me a second. Okay, trade management strategies such as stop loss order, position sizings help traders to limit their potential losses and manage their overall risk exposure. Maximum profit. Okay, we use maximum profit to such as take profit orders and also trailing stop orders to help traders lock in profits and maximize their returns. And we look at manage emotion. How manage emotion is important because it helps to discipline, provide like a structure, you know, that help you to trade and even stay calm and rational even in very volatile market, which can prevent impulsive decisions driven by fear or greed. So the next one on trade management will be improve trade efficiency. What it means by improved trade efficiency is by having a well-defined trade management plan. Okay, traders can make faster, more informed decisions and avoid the cost and time of having to consistently monitor and adjust their positions. And the last one would be increased trade consistency. Okay, this is effective in helping individual to achieve consistent results over time by reducing the impact of individual losses and maximizing the impact of winning trades. So in summary, okay, management is an essential component of successful trading and helps traders to make informed, disciplined, and profitable decisions in the financial markets. Okay, let's take a look at this example. The red area shows a strong resistance area since there have been two swing highs in line in this area. Okay, you can see two swing lines here. So price has reacted off this area twice. Okay, then imagine your strategy requires us to have a fixed take profit of 100 pips. This will place the target beyond this strong resistance area. Okay. Okay, let's see how this plays out. Okay, so this is our target profit and price shot up before reversing back down. So price tends to reverse off a big areas of resistance and support. So this is the problem with fixed take profit. So in an alternate scenario, if we have placed the top profit taker before the key resistance level, okay, which is over here instead of this area here. Okay, I'm gonna use a pen for. So we'll place it here instead of here. Okay, we have got a profitable trade. So if we place here instead of here, we have a more profitable trade. So it's important to look at the chart and adjust your take profit and stop loss accordingly. Okay, so next up will be, we will be looking at proper stop loss and take profit placement. Okay, so the proper stop loss and take profit placement to ensure you maximize your wins and also minimize your losses. Okay, so stop loss should be placed beyond the resistance level. Okay, this is your resistance level. Okay, so we'll place our stop loss ideally to place it beyond this level. Okay, highlighted in yellow here. While TP, which is your take profit, should be placed before. So we have another resistance area. Okay, and your take profit should be before, because you wouldn't want the price to, there's a possibility the price wouldn't, you know, go beyond the resistance level. So you want it to place it here instead of here. Okay. Okay, stop loss beyond means you should always okay, so this is a trade with Fibonacci confluence. Okay, stop loss beyond means you should always put your stop loss beyond the key Fibonacci confluence area. Okay, the reasons for this is because more often than not, price is attracted to strong areas of Fibonacci confluence. If your stop loss is right before instead of beyond, you'll most likely get stopped out before the market reverse. This is one of the reasons most people wonder why they got stopped out right before the market starts to reverse. Okay, and for take profit, you will put it before. Okay, before means you should always put your take profit target before a key Fibonacci confluence area. Okay, the reason for this is because price reaches the Fibonacci confluence area and there is a high chance you will not go beyond it. And instead of reaching your profit target area, it reverses back to your entry. Or even worse, your stop loss. Okay, so you don't want it to reverse back to your entry and your stop loss. Okay, this is also why people complain that market is being manipulated because they missed their TP. Okay, so this is an example over here. So this is for the stop loss. Place beyond the Fibonacci confluence area here. Your profit taker, place it before. This is the Fibonacci confluence and place your take profit before. So you are able to hit your take profit. Okay, so here's another example to show you why you should have a fixed stop loss. Okay, here we have a support level with two swing lows in line with one another. Okay, one swing low and second swing low. Price has bounced off this support level, and we are expecting it to continue to rise to the swing high resistance area. Our stop loss of 100 pips is fixed at 1894.75 level at the support level. Okay, so nice support level over here. So we buy here thinking the price will go all the way up. So our strategy has a fixed stop loss, which is right below the nice support level. Okay. And when price goes down instead, touches the stop loss and bounces up from the support. Okay, so does it sound very familiar? Okay, so if price reverse or drop down and it bounces off. Okay, so what we should have done instead was to place our stop loss slightly beyond the key level of support and resistance, so they will not stop out at the support, as price tends to be attracted to key levels of support and bounces off them. Okay, so look at the previous chart. A stop loss was placed here. Okay, this is fixed stop loss. It's placed here. So instead of doing this, we place our stop loss beyond the support or resistance level. So when price goes down, it will bounce off this level nicely and will not hit your stop loss. Okay. Okay, this is why it's important to have a dynamic stop loss and take profit placement. Okay, dynamic stop loss is trading strategy used to manage risk in which stop loss level is adjusted dramatically based on market conditions. The level of the stop loss is continually moved to a more favorable position as the price of an asset moves in a desired direction. The goal of a dynamic stop loss is to lock in profits while minimizing potential losses. The placement of the stop loss can be determined by various technical indicators or other market conditions, such as volatility or market trend. Okay, here's a simple example to demonstrate dynamic stop loss. Okay, so price has bounced off nicely at the support level. Okay, at the 86.721 level, which is here. Okay, it bounces off. Okay, and we expect it to reverse off the entry at 87.819, which is here. Okay, it's in line with the 100% Fibonacci projection. So we expect it to do this. Okay, we're expecting it to bounce. Okay, so price is testing the 87.819 level at the entry. Okay, so stop loss should be placed beyond the Fibonacci confluence area instead. Okay, so we should place beyond. Our stop loss should place beyond this area, which is here. So if you place your stop loss here, we have been stopped out. Okay. Okay, so this is before, because you want the price to go down, right? You're expecting the price to go down. So price reversed perfectly off the confluence area towards our TP, which is here. So it did not hit, it did hit this area. So if your stop loss was placed here instead of here, okay, this is the correct one, you have been stopped out. So this is what we meant by placing beyond the confluence area. Okay, now let's look at another example. We expect price to bounce off our entry at 87.625 level, which is here. at the pullback resistance is also in line with the 78.6 Fibonacci retracement area. So price has hit our entry and has reversed nicely off and heading towards our TP. Okay. Okay, so this is another one that shows that price has touched our TP before reversing off. So price has touched our TP and rose to our stop loss level. Okay, this is another example. So TP placed beyond the confluence area, price will reverse off and miss our TP by a few pips. So if you place below the confluence area, the price will hit our TP before reversing back down to our entry, okay, which is here. So it touches nicely this TP. So this will be our confluence area. So for profit taker, you want to take it before. Okay, you want to place your TP before the confluence area, which is this green line here. Okay, so when the price rose, okay, it will hit our TP nicely before reversing down to our entry. Okay, next up, we'll be looking at chasing losses. So chasing losses is also known as a revenge trading. Okay, happens when you let your emotion cloud your judgment, even more so when you don't have a trading plan. Okay, break even. Now we'll be looking at break even. So break even in trading refers to the point at which a trade reaches a level, okay, where the trader neither had made a profit or suffer a losses. Okay. So this is an example. Okay, this is an example of break even. Okay, it's the point where the cost of the trade, including fees and commission, is equal to the price at which the trade was executed. So, for example, a trader buys a stock at $100 and sells it at 110. The trader made a profit of $10. On the other hand, if the trader buys a stock at 100 and sells it at 90, the trader suffered a loss of $10. However, if the stock is sold at $100, the trader has neither made a profit nor suffered a loss, and the trade has reached a break-even point. Break-even is an important concept in trading because it helps traders to determine the minimum price they need to sell their trades in order to cover their costs and avoid a loss. Okay, this information can be useful in deciding when to close a trade and take profit or cut losses. Okay, here is an example of break-even. Okay, so break-even is a level where you are in profit and recognize that there's a risk of reversal. Okay, so over here, you can see it has reached the break-even point and there is a risk of reversal. Okay, hence we have an entry at the breakout of multiple swing high resistance level. Okay, where we are hoping for a price to push to our TP. Okay, take note of our original stop loss at 0.2. This is our stop loss line. Okay, then at 0.3, which is here, price reaches our break-even point and even reverse of it. Hence, we move our stop loss, okay, to the entry to protect our position. So these are original stop loss, and we move our stop loss here because the price has moved reaches our break-even point and reverse of it, so it goes even lower, so you want to cut your losses. Okay, so if price continues to our position, then good. Okay, but if it reverts back to our entry, okay, you want to be protected. So here you can see the price is broken above the break-even, but quickly reverse and hit up stop loss. Okay, and after then other than break-even, there is another concept called partial profit. Okay, it's typically used when there is a strong resistance area and you're unsure if price will rise to your take profit. Okay. Okay, so it means by taking a trade, okay, when it reaches a certain profit target, okay, while leaving the remaining position open in order to potentially capture further gain. Okay, so the idea behind is locking some of the gains while giving the remaining position room to move in the desired position. Okay, so here's an example. If a trader buys 100 shares of a stock at $100 and it rises to 110, the trader might choose to sell only 50 shares, take a partial profit of $500. The trader will then still have 50 shares that are still now worth $550 and could potentially continue to make profits if the stock continues to rise. So partial profits can help traders manage risk by allowing them to take profits off the table while leaving room for further gains. It also helps to improve the average price of a trade. So if a trader decides to add to the position later at a lower price. However, please take note that for traders who have a well-defined plan for how they will manage their partial profits, as leaving too much of a position open can also increase exposure to risk. Okay, so we have an example here that we expect our price to rise to our TP, which is here, but there is a strong resistance at the Fibonacci confluence area here. Okay, so price reacted off the strong resistance area at our partial profit, and it reversed off instead of heading to our TP. So it reversed off. Okay, so this is the before, and here's the after. So this is the break-even point. The price reverse. Okay. So stop loss adjusted to entry to minimize the loss. Okay, so previously you can see stop loss is placed here at 0.681 level. And next, we adjust the stop loss to entry level instead to 0.68. Okay, to minimize the loss. Okay, so next is ideal invalidation. It's usually placed before your stop loss. Okay, is the level which you basically admit, okay, you need to get out of this position. So when this level is reached, your take profit is moved to your entry, giving you a small chance to get out at break even. Okay, so at the first entry, sell entry, hoping for the price to drop all the way down to our take profit target. Okay, and this is our original take profit. Okay, then we realize that okay, it's a wrong entry. Then we move the take profit to entry level. So we adjust it here. So this helps us to get out of the losing trade. Okay, so in trading, the idea of invalidation refers to the process of evaluating a potential trade idea and determine if it should be disregarded or acted upon. Essentially, is a way of determining if a trade idea still holds up in light of new information or market conditions. Here's how the process of idea invalidation typically works in trading. Okay, so we have an initial trade idea. Trader thinks about an idea of a potential trade. based on their analysis of the market condition and also technical indicators and also other factors. Then next, we will evaluate the idea, okay, by looking at the current market conditions and also other informations such as economical data to see if the initial idea still holds up. Next will be invalidation criteria. Okay, the trader will then establish criteria for invalidating the trade idea, such as specific price level or market condition. They will cause them to reconsider the trade. Next, we will continue. The trader will monitor the market, okay, and also the security in question to see if the invalidation criteria have been met. So once the invalidation criteria are met, the trader may choose to exit the trade or adjust their position. On the other hand, if the criteria are not met, the traders may continue to hold the position or to add in. So in short, idea invalidation is a crucial step in trading process that helps traders make informed decisions about their trade and avoid potential losses. Okay, so here's an example. It's your original entry and your take profit level. Yeah. And here's your stop loss. So this is the point where we realize, okay, this could be a criteria for idea invalidation. So this is the point where it touches the Fibonacci retracement area. Okay. So now the price, instead of going to take profit level, it has moved down to this area of idea invalidation. And next, we will shift our take profit originally from 0.73 level. And now we move it down to our entry level. So our take profit will replace the entry level. So hopefully once the price bounces up, okay, we will be able to take profit at break even. Okay, so we are able to exit the trade with minimum losses or even no loss because we are exiting the trade at break even as per example here. So if we continue, okay, instead of adjusting our take profit level, okay, price will stop us out. Okay, and next we'll look at trailing stop loss. Okay, so it's a type of stop loss that is set at a certain percentage or dollar amount away from the market price. The idea behind a trailing stop loss is to lock in profits while giving the trade room to breathe as the stop loss follows the market price as we move in the favor of the trade. Okay, so here's how it works. So let's take a look at this example. So let's say you buy a stock at $100, okay, and you set a trailing stop loss at 10. The stock price rises to 110. The stop loss will follow. Now at $100, if the price drops to 100, your stop loss will trigger, selling your position and protecting your profits. The trailing stop loss technique can be useful for traders because it allows them to manage risk and lock in profit dynamically as the market moves. This is different from a fixed stop loss, okay, which is set at a specific price and does not change as the market moves. It's important to note that the trailing stop loss is not a guarantee that you exit a trade at a desired price. Okay, so market conditions such as gap ups or rapid price movement can trigger a stop loss order before it reaches your desired level. So leading to an unexpected exit from the trade. Okay. Therefore, it's important to use some trailing stop loss in combination with a solid risk management strategy. Okay, here's a summary of different types of trailing stop loss methods, and we'll be going through. First is the moving average indicator, okay, followed by parabolic chandelier and ATR indicator, and also support and resistance level, and a combination of these methods. Okay, this will be your moving average. Here's an example of your moving average stop loss. Okay, here will be your sell entry. Okay, so this is how the trailing stop loss will be triggered. Okay, so you place your trailing stop loss here. Okay, so we got out, okay, before the price rose. So this is trend line trailing stop loss. Okay, this is your trend line here in your sell entry. So when price move up, hit this trend line. Okay, we got out before the price rose even further, protecting our profit. Okay. Okay. Next up, which is the chandelier ATR trailing stop loss. So we have our sell entry here. Okay. This is the ATR stop loss. So it follows the ATR range, which is the average trading range. Okay. And this another one, the one with dots, is the chandelier stop loss. Okay, so you can see we can combine them together. So once the price has reached this level, the stop loss will be triggered. Okay, here's an example of using this stop loss, this trailing stop loss. Okay, so it moves accordingly to your chart. Okay, so your take profit will be here. Okay, this blue line is your moving average. Okay, here is just another example. Okay, so next is using breakout as some trailing stop loss. So breakouts are usually high volatility events. So price can spike up and reverse very quickly. A stop loss will help you to manage risk and also protect your capital. So trailing stop loss can help you to also protect your profit. So here are actually the pros of using a trailing stop loss as compared to a fixed stop loss. Okay, next we look at another mistake that a common mistake that new traders tend to make. Okay, which is ignoring fundamentals. Okay, it's important to distinguish between microeconomics and also macro economic activity. Some news may impact a particular city such as Tokyo in Japan or Dallas in United States. In other circumstances, a country like Germany may benefit or be hindered by economic news more than its neighbors. Okay, so as extending further out, an announcement made by the ECB is likely to have a greater influence on Eurozone markets than those of African nations. So it's important to keep track of the leading economic index or range of composite index, such as the constituent index or major economies. Okay, so use the information at hand to help you gauge the economic sentiment and also volatility levels of the instrument that you are trading. Okay, so here's an example of the FX news calendar. Okay, so it allows traders to sorry, give me a second to load the chart. Okay, this is the FX news calendar. It allows traders to see at one glance all the important data release. Okay, so you can see key events for GDP, CPI, and also central bank policy meeting. So you can go to this website here. Okay, so actually on the website you can search sort it by day. Okay, then you see the calendar of events, daily ones, and you can see here, let me use a pen. Okay, importance level. You can see which are more important to like example, these two are 2 stars, so these are actually more important events than the ones, you know, compared to, let's see, if I want there is no, I don't want there's 1 star. So for example, for US, you can see here, okay, this event are 2 stars event and this 1 star event, so this will be more, this will tend to affect the US dollars more than this. So it's good to see the forecast and also the actual. Okay, so after comparing, you can kind of start to analyze whether the result, you know, the result were, whether you will hinder the economy, okay, or benefit the economy. Okay, so let's look at some of the important events. Okay, so we have the FOMC meetings, which the Federal Open Market Committee is the US Fed way of communicating their views on monetary policies. So it will affect your dollar. Okay, and the one that we are, I think, very familiar with, which is the Fed interest rate decision. So normally it comes together with the FOMC meeting. So we see the stock market and also the dollars get very affected, okay, by this meeting. So if, example, these are some terms that they tend to use. So if Fed is dovish, okay, means USD is bearish. So if Fed is hawkish, okay, it will benefit the US dollar, we make it bullish. And next is if IR goes up, okay, USD will be bullish, and IR goes down, USD tend to be in bearish market, but a bearish condition. Okay. And next, we also have a non-farm payroll. It measures the change in citizens they are employed from the previous month. This exclude the farming industry. Okay, that's the name of non-farm payroll. And also another important one that we can look at is the unemployment rate. So it measures the total employment of workforce that's seeking active employment from the previous month. So the more people there is unemployed, so I think it will affect the economy badly. Okay, and here is crude oil inventory. This is a weekly update, weekly event. It measures the weekly change in the amount of crude oil held by US firms. Okay, so if crude inventory increase, oil prices tend to drop because there's more supply than demand. Okay, and next will be the EIA. It's a short-term outlook. Okay, it's a monthly forecast for the year ahead. The demand and prices across major fuels type. So, okay, these are the high impact events that will affect oil and oil prices. Okay, so when you're using the FX calendar, it also depends on your trading style. Okay, it helps to plan trades and allocation for the day or month ahead. So it helps you to plan ahead. It also helps to alert the individual upcoming important news that may affect volatility. Okay, so events like these will affect your volatility. Okay, like important news like, you know, CPI here, core CPI, okay, rate statement. These are things that will affect your currency, okay, the economy and also the currency. So these events tend to have made the market more volatile. Okay, and lastly, we'll look at how to set up your trading journal. So this is just a rough guide. Okay, so you can either use an Excel or do it in Word. Okay, so choose a format that you like, or you can, you know, look for some template online. Okay, decide on the categories. So example could be your entry price, your stop loss, your take profit. Okay, so and also capture your details and currency pair, example like currency pairs, and also indices. Okay, and analyze your trade performance. So after you have entered a trade, so you can key it into your trading journal, and after you have closed off a trade, key again in your trading journal again, and then after that you can analyze your trade performance, and also you also can jot down your emotional factors. How does it affect you emotionally? And okay, so review and adapt, and also maintain a discipline, like how should your profit taker, when should you take profit and when should you adjust your stop loss. Okay, so a benefit of setting up a trading journal is helps to improve performance analysis. Okay, it helps with your learning development. You'll be more aware of emotion and risk management, which is very important. Okay, it helps to plan your trade and execute it. Like example, how much take profit that you want to achieve and whether your execution is correct, and also gives yourself an accountability and discipline. And also once you look back at your trading journal, you look at the success, more and more successful trade, it also builds your confidence. Okay, so let me go back. We still have some time left, so let me go back to the, okay, I'm going to show you this. Okay, so this will be, okay, this is an example. We can see my screen of the economy data, like example investing.com. You can go to news under news tab and economical data. Okay, so we can sort it like the default is today. Okay, so looking at today, here are the important data for Euro, and let's see if there's any US one. Okay, so we have an S&P Global PMI. So you also can click on this for more information and what is this economic data about and how it affects your currency pair. Okay, so okay, and then you go back. So these are what will be released today. Okay, and also there's a time, and also you can change to tomorrow. Okay, and also next week. So next week it will look something like this. So looking through at the data will help you to plan your trade. Okay, maybe you want to avoid, say, next week, you know, on the 12th of December. Okay, so if you are trading US, you may want to wait for this data to be released. As you see on the 12th of December, they are actually core CPI data they'll be releasing, and it's the importance level is actually 3 stars. Okay, so we click on it. This is the monthly data. Okay, this is the last release. Okay, over here is the last release. Okay, the next one will be on the 12th of December. The forecast is not out yet, so it'll be out nearer to date. So you also can compare the previous data, and also there's a chart to see how the forecast will go, and also the previous the actual data that has been released and how, and they also have a little summary on how it's going to affect the US dollar. Okay, so example for the CPI, higher than expected reading should be taken as a positive or bullish for the USD, while the lower should be taken as a negative or bearish for the USD. Okay, so actually the forecast is also very important because you will use the actual data to compare with the forecasted data. Okay, so it helps you to kind of be able to forecast the market, whether it would be bullish or bearish for the US dollar. Same for other country economical data. Okay, like the one for pound. Okay, so the GDP for the pound also. There's an actual and forecasted. So a higher data, that expected reading should be taken as a bullish one, and lower reading should be taken as negative. So we can use this as a guide, okay, on how the price will go. Okay. So it's good to take note of the importance level. So there are actually a few websites whereby you can look for all these key events. So this is just an example. So if you Google it, like FX news calendar or the market economy events, you can see there are various websites. Okay, they have this event shown. Okay, so please let me know if you have any questions. Okay, and here's an example of high impact events. So like the one that I mentioned is, okay, this should include. Okay, so we have gone through all the slides and also the 7 points, 7 common mistakes that new traders tend to make. So it's important to, just to recap, it's important not to have a fixed stop loss, okay, and also not to have a fixed profit taker. So you have to adjust it accordingly for every trade, okay. So please let me know if you have any questions, okay. And here's a disclaimer again. Please note that these are for educational purpose. It should not be constructed as containing investment advice or investment recommendation. Okay, and also please do your own due diligence and research before you start trading. So thank you everyone for joining today's session. Okay, if you do not have any more questions, okay, I'll be ending the session today. Thank you and see you at the next webinar for IC Markets. Thank you.